So the dollar is on track for its third straight weekly decline. Jobless claims just had their biggest jump in over 4 years, and gold is trading above 4,270. If the Fed was trying to calm markets, I think it actually accidentally handed them an extra espresso shot instead. So before you place your next trade, watch this.
Why is fast trade execution a must? Because you're more likely to get the entry price you want and the exit price you want. Reliable, rapid, responsive. Join ATFX today and let's get you started.
Good morning, I'm Francois, your market analyst here at ATFX Africa, and welcome to your daily market brief. Each morning here we unpack the biggest market drivers across currencies, commodities, and indices, mixing fundamentals, technicals, and well, just enough logic to make sense of it all. Let's start today with the cable. Now, the dollar index is hovering near 2-month lows around 98.3, on track for its third consecutive weekly drop. The trigger? Well, number one, the Fed cut rates as expected. Number two, they delivered a less hawkish outlook than markets feared, and Chair Powell signaled that further rate hikes, are unlikely. Fed projections still only show one more cut next year, but markets are already leaning towards a softer path. On top of that, the Fed plans to buy short-dated treasury bills, roughly $40 billion worth, to support liquidity. Yields have also moved lower. Jobless claims just saw their biggest rise in nearly 4.5 years, reinforcing the, dovish tone. Against that backdrop, the British pound has surged towards $1.34, its strongest level since late October. Now, on the UK side, things are also quite interesting. Expectations for the next Bank of England decision are still for a cut, with roughly 84% chance priced in at this specific stage. Markets are also leaning towards a 25 basis point cut again by June, with strong possibilities that it can also maybe come as early as April. Yet, there are still signs of accelerating wage growth with sticky inflation, which keeps the Bank of England story more nuanced than purely dovish. So, you've got a softer dollar and a Bank of England that's easing but careful, and a market, that's happy to push GBP USD higher, while the Fed's credibility as the hawk in the room takes a bit of a breather. Looking at the charts, GBP USD is clearly in bullish territory. Price is holding near 1.34, having broken through a key confluence zone around 1.333. That area combined the 100-day exponential moving average and the 38.2 Fibonacci retracement of the September-November decline. A major hurdle that bulls now cleared. Then again, on the top side, a move beyond, roughly 1.347, which is the 61.8% Fib retracement level, could open the door back up towards that psychological 1.36 handle. On the downside, any pullback must first clear that 1.33 level as initial support. And if that happens, that could open the door back towards 1.314 or deeper support, which is sitting at that psychological 1.3 flat, where a decisive break of that level would start to challenge the current bullish bias. For now, the technical structure and macro backdrop are aligned. The trend leans higher, but it's still a Fed and data sensitive environment where sentiment can flip really quickly. Moving over to commodities, gold is once again enjoying its favorite combination: a softer dollar, lower yields, and rising hope for further easing. Gold is currently trading around $4,275 per ounce, near a 7-week high and heading for a weekly gain. Over the past month, gold is up about 2.4%, and over the last year, it's gained more than 61%. It remains not too far from the all-time high, which is sitting near 4,381 set in October. The drivers here are relatively straightforward. The Fed just delivered its third 25 basis point cut, as said earlier. Powell signaled additional rate hikes are essentially off the table, which means, well, with jobless claims also rising more than expected and hitting their highest level in over 2.5 years, underscoring a cooler labor market, with, on top of that, the Fed decision to purchase the short-term treasury bills to ease money market strain, is all expected to cap short-term yields and support risk asset. And importantly for gold, reduce the opportunity cost of holding a non-yielding asset. So in other words, lower yields plus higher macro uncertainty equals a friendlier backdrop for gold. Looking at the charts, gold is in a very strong position. Price is hovering around 4,275, consolidating near a 7-week high. The market has pushed back above the 4,260 region, which now acts as an important near-term reference point. Recent price action shows a strong move higher following the Fed's 25 basis point cut and softer jobless data. Persistent buying interest on dips as long as the Fed's tone remains dovish relative to expectations. However, there are also mentions that positive developments around Ukraine peace efforts may cap some of gold's upside, given its role as a traditional safe haven. That introduces an interesting tension. So, on the one side, we have monetary policy and yields that are supportive, but any perceived reduction in geopolitical risk can limit the urgency to chase fresh highs. So, for now, gold looks like it's in a buy the dip, not the panic spike environment. Supported by policy and data, but still sensitive to shift in risk sentiment. Let's finish things off today with the FTSE 100 that rose 0.4% on Thursday, extending Wednesday's 0.1% gain and putting together a modest 2-day advance. What's behind the driver? Gold's strength, surprisingly enough, has helped precious metal miners. Fresh Nilo was up nearly 4%. Endeavor was up almost 3%. Then on the other side, we also had big defensives like HSBC, AstraZeneca, Unilever, and GSK adding somewhere between 0.4 and 0.7%. We also had Rio Tinto and Barclays gain more than 1%, contributing to the broader move higher. However, not everything participated. Informa slipped 3%, BAE Systems dropped 1.3%, and Rolls-Royce fell 0.6%. Interestingly, however, concerns over AI spending and strict tech evaluations, triggered earlier by Oracle's update, have eased in Europe, allowing UK equities to grind higher rather than get dragged into the same tech-centric pullback seen in parts of the US market. Traders are also boosted by bets of a Bank of England rate cut in later in 2025, with Friday's UK GDP print highlighted as a potential catalyst that could reshape those expectations. Looking at the chart, FTSE market structure looks as follows. It's currently trading around 9,735, up 0.49% from the previous session. Now, over the past month, it's down 2.1%, but still 16.74% higher year on year. It remains below its record high near 9,930 reached in November. That combination, well, of the highs slightly softer over the month, but still stronger over 12 months, points to one thing: a longer term uptrend that is still intact. Near term price action, also that looks more like a consolidation phase rather than a reversal. So, in short, the FTSE appears to be doing what a mature bull market does after a strong run: digest, rotate, and wait for the next big macro cue. Heading into next week, the key questions are as follows. Is the cable, going to build on its breakout above 1.33, or do Bank of England communications and UK data yank some of that optimism back out? Gold, can it sustain levels above 4,260 if the market keeps leaning towards more easing than the Fed officially projects? And lastly, the FTSE 100. Will a mix of Bank of England expectations and UK GDP keep the index grinding higher? Or does global risk sentiment finally catch up with it? Well, we'll unpack all of this in next week's Market Brief. So with that, we wrap up your daily Market Brief, brought to you by ATFX Africa, the broker that gives you an edge in today's markets. Simply head over to atfx.com and go and experience the difference for yourself. Traders, until next time, stay sharp, stay focused, and trade smart.